Hello, everyone, and welcome. Thank you for joining us for today's webinar, The Buy-Sell Advantage, a solution for complex global transactions. Today, we're unpacking a challenge that many global businesses face, but often don't clearly name, the gap between international supply and local procurement. Now, many businesses can source globally, many resellers can sell globally. But when hardware needs to land in complex destination countries, the transaction itself can become more difficult. The end user may need a local invoice, they may need to pay in local currency, they may need to recover the VAT or GST, and in some jurisdictions, they may not be able to remit the funds to a foreign seller. And that is where the TecEx Buy-Sell solution becomes especially relevant. Our own buy-sell solution is a way for resellers to import and sell goods in a tax-efficient way while allowing end users to procure locally. Our panel today encompasses myself, Cassandra Clarke. I'm the head of training at TecEx, and I've been with the company for 9 years. I'm joined today by two fantastic speakers, Anthony Rousseau, our Chief Revenue Officer. He will be speaking to the commercial and customer challenges behind the solution. And Jessica Lawson, our head of finance, who will help us unpack the financial, VAT, Forex, and remittance considerations for buy-sell transactions. Anthony and Jess, thank you both for joining.
Hey, Cass, thanks so much. Great to be here.
Thanks, Cass. Looking forward to the conversation today.
So before we jump into the core of the content, just a quick note on today's structure. We will be spending our session talking through the concept, the challenges, the benefits, and also looking at a real-world case study. And then we will leave the final few minutes for Q&A. So TecEx is already a well-known importer of record partner. So why are we even talking about buy-sell transactions? Anthony, what does this problem solve that a standard IOR shipment does not fully address?
Yeah, thanks for that, Cass. I think that's really the perfect place to start with this, and really unpacking the core differences in what problems we're solving. So a standard IOR solution is incredibly valuable because it solves complicated import compliance challenges, and it helps actually physically get goods to the destination country correctly, compliantly, and efficiently. However, in many global deployments, import compliance is only one part of a larger problem. And the bigger commercial question that often surrounds that problem is, how does the end user actually pay for the goods? And how do they actually need to buy them? Or in other words, how is this transaction actually structured? So for a great example is the end user may need to procure from a local entity. That may be an internal policy requirement. Their internal procurement policy may require a local supplier that is domestically incorporated into the jurisdiction they're procuring in, or their finance team may actually need a local tax invoice for one of many possible reasons. And I think especially important, from a commercial and a cost perspective, is they may need to pay in local currency and then want to recover local VAT or GST, which can be a significant cost of sale. A standard IOR model may get goods to country, but it doesn't solve all of the complicated commercial issues that we just covered. And the buy-sell was developed by TecEx to really slot into the gap between those problems.
So as you say, an importer of record gets the goods in country, but the buy-sell solution makes the local transaction actually work.
Yeah, exactly. I think that's the perfect summary. It's really the next layer. It combines import compliance, transaction structuring, local procurement, and financial efficiency to build the perfect trade solution.
Yeah, and that's a really impactful distinction. Jessica, from a finance perspective, why does this distinction really matter?
Thanks, Cass. So this distinction matters because the way a transaction is structured will directly affect the cost, cash flow, tax recovery, and the payment risk. Two transactions can involve the same goods, same seller, same end user, but produce very different outcomes depending on who imports the good, who invoices who, what currency is used, and whether the tax documentation supports this recovery. So when we talk about buy-sell, we're not talking about logistics. We're talking about how to make the transaction financially viable.
So let's also define this concept clearly. Anthony, when we say foreign transaction or a buy-sell transaction, in this context, what do we really mean?
Great, Cass. I think that's an important point to make very clear. So in this webinar, when we use the term foreign transaction, we're using it to describe a cross-border sale where the seller is in one jurisdiction, for example, the United States, and the end user is in another. And the transaction needs to be structured so that the end user can actually buy that gear with a purchase order domiciled in the foreign geography. In a buy-sell model, as shown in the diagram that you can currently see on the screen, TecEx acts as a commercial intermediary, i.e. the foreign seller is able to complete the sale, but the end user gets a benefit of a local procurement. So the end user is not left trying to buy directly from a foreign entity, pay in a foreign currency, or navigate all the complexities of foreign exchange remittance without any support.
Right. So it's really about making the international sale feel more like a local purchase for the end user.
Exactly. I mean, when we sell this, what we actually say is when you buy the gear on this transaction, it's no different than buying stationery at the shop down the road. The end user gets a local procurement experience and the foreign seller gets a path into a complex import market without the necessity of having to establish a local billing presence themselves and then having all the complexity that goes with that.
And then from the finance side, the local procurement is important because it can affect the VAT or GST treatment, the payment flows, and currency exposure. The end user may not just prefer a local transaction. In some cases, the ability to recover tax or remit payment may actually depend on it.
Yes. So yeah, that's actually really important. So this buy-sell transaction is not more of a convenience solution. In some markets, it may be the difference between a transaction that actually works and a transaction that gets stuck.
Exactly that, yeah.
Now, with the buy-sell transaction, there are a couple of core challenges that we really need to address. Anthony, what are the main pain points that you've seen with customers and what they face before engaging with TecEx in a buy-sell scenario?
Perfect. I mean, just before we get into the exacts, a customer that structured one of these before speaking to us and we try to fix it after the fact is never ideal. So I think super important that we identify these in advance. The first is the risk of funds getting stuck in country, right? And that is because in certain jurisdictions, the end user may need to pay a foreign seller, but the payment cannot move out of that country easily. Some countries have very, very, very strictly enforced foreign remittance restrictions to protect local currency and to control capital outflows. Secondly, and perhaps most critically, is import VAT and GST considerations, especially that if the transaction is structured internationally incorrectly, this VAT and GST can become a sunk cost of the transaction. If the end user is not the importer of record, they may not be able to reclaim foreign VAT or GST paid at clearance unless it's done through a transaction structure like the buy-sell. The third is foreign exchange risk. These transactions span a long period of time. They need to be quoted, they need to be shipped, they need to be cleared, they need to be delivered, they need to be paid. Over this time, foreign exchange rates can move dramatically. And that can cause either the end user to pay significantly more if the foreign exchange risk is placed on them in the transaction, or alternatively, the foreign seller to have a complete margin erosion on their sale. The fourth is related party customs valuation risk. In certain countries, especially where related parties are involved, customs authorities may question declared value, and that can lead to significant revaluation risks.
So this also sounds like a lot for procurement and finance teams to actually manage. Jessica, from a financial perspective, can we unpack the first core challenge, the funds getting stuck in country?
Sure. So as Ant has alluded to, in some countries, foreign remittance is tightly controlled. One important principle is that only the actual importer may be able to remit funds out of the country for the imported goods. So if the end user is trying to pay a foreign seller, but the end user is not in fact the importer, the bank may reject or delay the payment because the payment in fact doesn't match the import of record. We had a case similar to this in India, which is a good example of this risk that can take place. This case study will be discussed a bit later on, but this is where we found that remittance can be limited to the original importer and that banks can validate payment details against the customs declarations on hand. If details do not match, payment can become very difficult to get out of country.
Yeah. So you may find yourself in a scenario where the end user has the money, but they can't necessarily move the money.
Exactly that, Cass. So the issue is not always liquidity. Sometimes it's the regulatory permission, documentation alignment, or banking validation. And commercially, that creates a very serious risk. The seller has delivered goods, the buyer has funds, but payment is delayed or trapped, and no one wants to be stuck in that situation.
Yeah, absolutely not. This makes the buy-sell structure sound like less of a nice to have and more of a risk management tool that the users can actually take on.
Exactly.
Yeah. So let's talk about something that I think will be especially relevant for the decision makers, and that is the opportunity cost. So on our slides, this table shows real world shipment values and the savings that were unlocked using the buy-sell solution. It covers Brazil, Chile, India, and Mexico. And this table shows savings unlocked of $266,000 in Brazil, $53,000 in Chile, $22,000 in India, and $60,000 in Mexico, with a total percentage savings ranging from 11% to 16% of the hardware value. Anthony, why is this table so important?
Yeah, great question, Cass. And I think it really is the difference between speaking in abstract terms and making the savings of a transaction structure like this really tangible. So a lot of people think about cross-border trade risk as something abstract. It's a compliance risk, it's a tax risk, it's an FX risk, it's a payment risk. It's difficult to explain. But when you really look at it with real shipments and real money, you can see that the cost of not structuring the transaction correctly can be seriously substantial. And the opportunity cost is not just administrative inconvenience. It can be irrecoverable VAT, irrecoverable GST. It can be foreign exchange losses. It can be withholdings tax exposure that wasn't factored into the original transaction. It can be a massive customs valuation, revaluation, or even a payment delay. And when you add all of those up, obviously the commercial impact becomes very, very real.
Yeah. So this is not only about avoiding problems, but it's actually also about protecting your margin at the end of the day.
Yeah, exactly. I think we've seen that to a huge extent with our reseller clients, is that margin protection is a critical element when selling internationally. And for end users, budgetary certainty is critical. Once that PO gets cut, it's kind of set in stone, and there's no way to change it. And the buy-sell really helps sort of balance those competing interests.
And from the finance perspective, this table is very powerful because it pretty much reframes the conversation. The question is not only what does a solution cost, the better question is what could it cost us not to use it?
Oh, Jess, that's a great line. I think the cost of inaction is sometimes harder to see, but in this case, the numbers actually make it so much clearer. So let's dig a little bit deeper into VAT and GST. Jessica, you mentioned that import VAT can sometimes become a sunk cost. Can you please explain why?
Sure, Cass. So when goods are imported, import VAT or GST is typically paid at customs upon clearance. But that tax is generally reclaimable only by the actual importer, subject to the local rules or tax status within that country. Now, many end users come to TecEx specifically because they don't want to be the importer of record on file. They may not have the registration, expertise, or internal approval to take on that role. But if they are not the importer, then the import VAT or GST may not be recoverable by them. That can turn a potential recoverable tax into a very real cost.
Yeah. So this issue is not that VAT or GST is paid. The issue is actually who pays it and who has the right to recover it.
Exactly. So in a buy-sell transaction, TecEx facilitates the import, then sells locally to the end user. The local sale can give the end user the local procurement documentation they need to support that VAT or GST recovery where the country rules allow for it.
Yeah. Can you please give us an example of that?
I think a good example that we've seen recently is India, where the end user was able to reclaim over $85,000 in GST. That's quite a substantial amount and really shows why tax structuring matters.
Yeah, that's a great point, Jess. And I think from a customer perspective, it really changes the entire business case of that transaction, right? If GST or VAT is treated as a sunk cost, it increases the landed cost of the project as an overall and the ROI of that entire transaction. But if it's structured correctly so that VAT is potentially recoverable, the economics can improve substantially.
Yeah. And this sounds especially important for large scale hardware deployments where even a percentage or two can actually represent quite a lot of money.
Exactly. And one thing I would stress is that a buy sell does not make the taxes disappear. That's not the message here. The message is that the structure can help ensure the right party has the right local transaction and documentation to support recovery where the recovery is legally available.
Yeah, legally available. That is an important distinction. And it's also important to know that this is not tax avoidance, but rather it's tax efficiency through proper restructuring.
100%, Cal.
Let's move on to foreign exchange. Anthony, Forex risk can sometimes sound like a finance only issue, but it's actually also very commercial. How do you see this affecting customers?
Yeah, I mean, it's a massive issue for sellers and international transactions. But I think before we go there, let's start with the end users. If they've budgeted in local currency for a specific procurement of hardware, and then the exchange rate moves significantly, let's even say by 3, 4, 5%, these are all very reasonable assumptions. The end user may end up paying substantially more than they had budgeted for. On the flip side, for the seller, if they're expecting to receive a certain amount in USD or another currency, the exchange rate movement against the foreign currency can significantly reduce what they actually receive after the exchange event takes place. And that directly affects margin, and that directly affects sellers. In hardware deployments, timelines are long. You quote today, you ship in weeks, you're paid in months, you clear customs after that. So every day that goes by really increases your exposure to foreign exchange volatility.
How does the buy-sell solution actually help with that?
Yeah, that's a great question. And I think it's really one of the most exciting parts of this product is that this product aims to provide a fixed foreign exchange rate, which in practical terms means that both sides have complete certainty. The end user knows exactly what they're paying in local currency for a period of validity, and the foreign seller knows exactly what they're receiving. Right? This helps reduce the risk that either party suffers a loss because the currency moved during the transaction timeline. A Nigerian case that we've recently experienced is a strong example. For anyone that knows, the Naira in Nigeria is a really volatile currency. During the 10 months preceding the transaction that we were actually involved in, there was a currency volatility change of 82%, being a depreciation of the Naira. And TecEx determined that in advance, and really use the fixed foreign exchange rate in advance to protect both parties from this volatile fluctuation that really would have sunk either buyer or seller in the circumstances.
Yeah, that's a really dramatic example.
Yeah, it is, and importantly is that it's not once off. We see this pretty often, and it shows why FX cannot be treated as an afterthought. In volatile markets, FX materially changes the economics of the deal and really is often the single governing factor between making a transaction workable or not. And fixed FX is not only about giving commercial certainty to both sides. The foreign seller is protected from receiving less than expected, and the end user is protected from paying more than they budgeted for in the first place.
Yeah. So effectively, we can wrap that up into one sentence. Fixed Forex turns currency uncertainty, in this example, into transaction certainty.
Spot on, Cass. That's exactly it.
Great. All right. So let's touch on another major consideration with buy-sell transactions, and that is related party risk. Anthony, what does this mean in the context of a buy-sell transaction?
Yeah, good question. And this is a little bit of a technical one, but related party risk becomes super relevant when parties that are involved in a transaction are connected in some way or related in some way. And often customs authority, when parties are related, have an assumption or at least get sort of nervous that the parties are not transacting under an arm's length sale. This is especially relevant in countries like Brazil and India, where customs valuations are frequently very closely scrutinized. And if customs authorities believe or have reason to believe that a value is not commercially independent or understand, and that those goods are therefore understated from a sale perspective, they may revalue those goods upwards, and that often can lead to higher duties, higher taxes, penalties for misdeclaration, delays, and long-term scrutiny on your importer code, perhaps most importantly of all.
Yes, very importantly. So even if you have the goods moving correctly, it's actually also the declared value that can still become a problem.
Exactly. So the movement of the goods and the value of the goods are both important and in a way kind of distinct in a transaction like this.
Mm.
And financially, customs revaluation is difficult because it can create unexpected costs after the transaction has already been priced. That can affect seller's margin and end user's budget or both.
Yeah. How would the buy-sell help with that solution, with that problem?
So by supporting a properly structured transaction at arm's length values, TecEx specifically identifies related party risk mitigation as one of the key benefits of the buy-sell solution, including helping avoid potential customs revaluation.
So again, we're seeing that it's about making sure that the commercial structure, the import structure, and the valuation basis are all aligned at the end of the day.
Exactly, Cass.
Let's bring all of this home with a real world example. Anthony, can you walk us through the Nigeria case at a high level, please?
Sure, thanks, Cass. So in the Nigerian example that we're going to cover, a world-leading reseller needed to ship around $3.1 million worth of IT hardware into Nigeria for a very prominent end user. The customer had two key requirements. One, they did not want to take on the full bureaucracy of import and export regulations, and they wanted the end user to be able to buy locally in Nigeria. This presented several challenges for us. First, complex trade compliance, customs requirements, currency fluctuations, as we've already mentioned, and difficulty with USD remittance in Nigeria. The buy-sell solution enabled the local procurement, helped remove the threat of FX fluctuation, and supported efficient tax recovery, whilst also reducing related party risk in the transaction.
Yeah. Jessica, from your side, financially, what stands out for you about this case?
So two things stand out from the scenario Ant has mentioned. The first is the FX issue. The Naira had devalued significantly before the transaction. So fixed FX protection was very important in this scenario. And the second being the VAT impact. The end user was able to reclaim over $378,000 in VAT, which is a very meaningful financial benefit for the client.
Yeah, that's exceptional. And we can actually also see with India, it gives a bit of a different slightly angle, right?
Yes. So India is especially useful for understanding remittance and GST complexity. The India example involved a hardware shipment where the end user needed to pay out of India, but India's remittance process created significant complexity. We found that the end user received local sales invoices and was able to reclaim over $85,000 in the GST.
Wow. So the Nigeria example shows the power of buy-sell in highly volatile Forex and VAT environments, while the India example shows the importance of remittance alignment, GST, and local procurement.
Yeah, exactly that, Cass. It really is a all-inclusive trade solution.
Right. So as a company wanting to deploy tech across borders, you might want to consider a buy-sell solution specifically when the end user is buying locally, local currency payments is required, VAT or GST recovery matters to you, and where there is a risk of Forex or remittance. You may reconsider the buy-sell solution if the end user is importing directly, the local remittance is simple, foreign exposure is minimal in that territory, and your local entity already exists and regularly imports similar infrastructure. Thank you both, Anthony and Jessica, for joining me today as the panel. Your knowledge and your expertise really reaches far into this topic, and I'm sure that a lot of people will find value in this. We're going to wrap up the webinar today just with a couple of questions. So important for us to address is really for everybody in decision making. What is the simplest way to know whether or not a buy-sell solution should actually be explored with TecEx?
Yeah, it's actually a really simple question. So one, does the end user have a desire or requirement to buy locally? Is there a risk that GST or VAT becomes irrecoverable in that country using that transaction structure? And thirdly, could remittance or FX volatility directly affect payment and margin? If the answer to any of those is yes, or potentially yes, buy-sell is definitely worth considering.
Great. Jess, why do funds actually get stuck in country at times?
Sure, Cass. So in some countries, banks or regulators restrict foreign remittances, either to protect local currency or control capital outflows. Payment may need to match the import record, and only the actual importer may be able to remit funds abroad. If the end user is not the importer, or if the payment documents do not align with the customs record, funds can end up being delayed or blocked in country.
Yeah. And which countries is the buy-sell most relevant?
Yeah, so it's really interesting. So it follows a pretty similar pattern in terms of where this transaction's at its most powerful. So we're really looking at countries where local procurement, remittance restrictions, and VAT and GST recovery is complicated, as well as countries with super high foreign exchange volatility. Usually that all relates around developing or emerging markets. And I think some great examples are India, Nigeria, Brazil, the Philippines, and other jurisdictions where transaction structures matter as much, if not more, than the physical import.
Amazing. Thank you, Anthony. Thank you, Jess. Thank you all so much for joining us today on our Buy-Sell Advantage webinar. This is a solution for complex global transactions. And I think, as Anthony mentioned at the beginning, it is so key for you to assess this prior to actually structuring your deal and your transaction. Because if you structure it without the right considerations and right alignments in place, you may find yourself in a very sticky situation later on down the line. So please visit the resources tab for the buy-sell cheat sheets and case studies, and reach out to TecEx to start assessing your buy-sell feasibility as soon as possible. Thank you all. Have a wonderful day.
Awesome. Thanks so much, Cass. Really enjoyed it.
Thanks so much, Cass.